So we're also keeping an eye on international stock markets, including China. Chinese stocks took some major hits following Wall Street's plunge. Shares are falling in Asia for the same reasons that they're falling here. Investors are worried about inflation and the Federal Reserve's raising lending rates.
So what happens, though, when a market meltdown starts in China instead of here in the United States? Here to walk us through it is Gabe Lipton. He's a CBSN contributor and signal writer for G0 Media and part of a new partnership between CBS News and G0 Media, a Eurasia Group company. Welcome.
Great to meet you guys. Thanks for having me.
So let's talk about what's at stake if and when the Chinese stock market becomes very volatile. What do we need to be here in the United States looking out for?
Well, I mean, if we take a step back, I think the big news of the week is obviously huge market volatility. The last time we've seen this sort of volatility was actually back in 2015, and it was exactly for the reason you mentioned, because of China, because of a sell-off in Chinese markets, because of a devaluation of the country's currency, and it was a very different event. If there were two silver linings for me from the events in the U.S. this week, it's one, that markets actually handled it pretty smoothly, right? There was no massive sell-off, nothing really crashed, there weren't major hiccups, and two, that people generally are pretty confident about the state of the U.S. economy. Now, when this happened in 2015 in China, it was a bit different. I mean, the Chinese system is very, very different than the U.S. system. And so a turbulence in Chinese markets is massively different than what we saw in the U.S. this week. Two major points. First, that at the end of the day, the major political and economic decisions in China come down to what 7 guys in the Politburo Standing Committee, the major sort of decision body of the Chinese Communist Party, decide to do. So it's not like the U.S. where we know what the Fed's going to do, we know how the U.S. Treasury is going to react. It comes down to what these guys say and the decisions they make. The second point is that Chinese data there's a history of Chinese data being pretty opaque and us not knowing exactly what the growth number is, what's happening. If there's a major crisis, we have to sort of ask what's going to be at the top of the government's priority. Is it going to be giving people a really clear picture of what's going on in the country, of what's going on in markets, or sort of maybe changing things to make things look a bit rosier than they actually are?
In 2015, I think I remember, you can correct me, they actually stopped trading in China a couple of times,
yes.
Right?
Yeah.
Right, because it had tumbled so rapidly. Explain to me how stocks in China affect the stock market here.
No, it's a great question. I mean, so a lot of U.S. companies, actually U.S. pension funds, are increasingly invested in China. So, if you're someone sitting at home, you may or may not have a 401k actually invested in Chinese markets, and you're probably invested in a wide array of Asian markets in Hong Kong and in what are called the offshore markets. So, the fluctuations there do impact your bottom line, and for U.S. companies that operate there, other investors who are invested there, it has a huge impact on them, and the rules of the game are completely different, right? And that's something we have to keep in mind when we're thinking about events in the U.S., how they spill over to China, how that might affect us here back in the States.
Mm-hmm. So there are a couple of risks for even American investors who are exposed to China. There is economic risk, which we've talked about, and there's political risk. How do you see the juxtaposition between the two?
Well, it's a great question. I mean, again, look, I think the silver lining for the U.S. is things have gone quite well in the last week, and we don't see politicians intervening and saying, the Fed should do this, they should run that way. We tend to think of the U.S. institutions as being pretty independent, right? The Fed decides when it wants to hike or cut rates, and the U.S. stock exchange functions, pretty seamlessly. In the Chinese system, it's a bit different, right? And there's famously the Chinese premier Li Keqiang told his people to get data for him because people were falsifying his briefs, and he wasn't getting a clear sense of on the ground in these local communities what things were looking like. So he told his guys to go out there and get him the real facts on the ground. So, look, the political dynamics, the economic dynamics, it's a completely different ballgame. I think the Chinese are moving to make it more transparent because it benefits them, and they want to attract foreign investment. But again, I mean, it really is a completely different ball of wax, and it may be that as China increases its market impact, the next sort of great financial crisis, the next great financial meltdown could be made in China.
Vlad had mentioned that here the fundamentals are strong, and that's sort of important. What do we know about the Chinese fundamentals, though? I mean, you talk about how it's a pretty opaque society, especially in terms of the economy. Is China strong?
I think it is. I mean, I think generally we've seen, especially in the last quarter of last year and the first quarter of this year, pretty substantive growth. I mean, China today is growing between 6.5 and 6.7%. A lot. The big problem China has is a huge amount of debt. China has the biggest debt to GDP ratio in the world, and it's trying to transform its economy from one based on investment and saving to one based on consumption. And so, when the companies are all basically government controlled, the 4 largest banks in the country are all government controlled, you sort of have to shift control of those things to the private sector. And a lot of that means letting institutions, letting big companies fail where otherwise you wouldn't for political reasons. So look, the Chinese economy, it's not going to crash tomorrow or in the next month. It's doing well. But I think as we see these global market dynamics play out, we have to sort of, compare and contrast apples to think about how these things would work.
Right, because didn't the Chinese government sort of launch a program to encourage people to take their money out of savings and put it in the stock market?
Exactly.
Because they just didn't have access to all that money.
Yes.
And then, come 2015, and suddenly the stock market starts to, tumble.
Yeah, exactly. I mean, they want people to invest, they want people to consume. That's the long-term plan. And actually, over the next 10, 20 years, that's the big economic transformation they want to make. But it's going to take time, right? And it's going to be painful in moments. You're going to have to let these big industrial titans fail, right? You're going to have to let, your big companies that, support thousands of jobs, change and adapt to the market realities that they're facing today, right?
I sort of think that, I remember very clearly, well, not only 2015, but the 1998 Asian crisis. And, it's interesting. We've always, when I worked on the street, we would show investors charts of the stock market, the U.S. stock market, going back to the 20s to, let's say, 2000 or, 2007, and we'd see an upward trend. And I sort of feel like we're seeing the same thing in China now. I mean, for the number of years that market has been available to us, for you Americans to be exposed to it, it's been an upward trajectory. We've seen volatility, and there will continue to be volatility, but I sort of am of the mindset that people should stop freaking out, because the way that we are, not only our market economy, but theirs as well, ultimately works itself out.
Yeah, I mean, today China is the second largest equity market in the world. It's the third largest bond market in the world.
Yeah.
And those trends are going to continue.
And we have a symbiotic relationship. They own a lot of our debt.
And we own a lot of,
right.
And we are continuing to invest in their companies, right? And they don't, as we mentioned with this sort of transformation, they have in their debt problems, it's sort of, again, both countries don't want things to fail, right?
Exactly.
It is really important. It's a relationship that is based on sort of mutual trust and participation in it.
Which is so
complicated. Mutual trust.
I know,
when I hear you say that.
And it's something that I've tried before I became a reporter, and I would talk to investors about this stuff. You hear politicians and the rhetoric and the language that is used when talking about a country like China as our adversary. But the reality is, as the money drives everything, and you point out that this relationship between the United States and China goes beyond a spy plane that got tipped in the sky by another spy plane. I mean, there are real economic drivers to this relationship that we don't want to disturb, and neither do they.
Yeah, we are both too big to fail.
Exactly.
And we don't want to see any